This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
The Alternative Investing Advantage podcast. My name is Alex Perny, and today we are very pleased to welcome on Matt Rodak, founder and CEO of Upright. And today, something near and dear to my heart and a lot of our other investors and listeners to this podcast is real estate. It's definitely a very popular topic, but we're going to be taking a bit of a macro lens view of the current market conditions that are affecting really what's going on in the real estate markets. It's been, there's certainly been a lot of tumult and things that are changing in this industry, but, where there is change, there is opportunity. Not everything is necessarily needing to be viewed through the lens of doom and gloom. Just because something changes doesn't necessarily mean it's inherently bad. You might need to adjust how you're viewing your investments, how you're viewing your strategies, and just adjust accordingly. People made plenty of money in the 80s and 70s when interest rates were 7, 8, 9, 10, 13% at some points. And certainly people can make money now. It's just a matter of kind of understanding what's going on and having to tailor your investment approach to that. So, Matt, I always like to let my guests give their own introduction because I feel like you know yourself better than I ever could. So tell us a little bit about, your career path, maybe a little bit about your education, your initial start in your career, and kind of how you became to the position you're in now with founding this company.
Yeah, absolutely. And thanks for having me, Alex. Again, my name is Matt Rodak, founder and CEO of Upright. And, my journey here really started all the way back in high school. And I had a small landscaping business. I grew up in small town Ohio, and through that landscaping business, ended up doing a lot of work for guys that were flipping houses. So one of my commercial clients was a residential mortgage broker, and a lot of the loan officers there were, buying properties, fixing them up, selling them, or keeping them as rental property. So got exposed at a relatively young age to, going to these homes, right when they were purchased and were in some levels of distress and dirty and needed cleaned out and, updated. And over the course of 3, 4, 5, 6 months, see these homes, turned into some of the nicest homes on the block. And just generally was pretty interested in what that, meant for the local neighborhood and home values. And these guys also weren't shy to tell me how much money they were making. So, as a 16-year-old, seeing someone make, $40,000 or $50,000, on a flip, if what they were telling me was true, I thought was an interesting way to make a living. So, kind of started to develop an interest in, everything real estate investing at a relatively young age. Sold the landscaping company, went off to college to study finance, really with the hope of getting into some type of real estate development investment post-graduation. Graduated in 2007, right when the housing market was starting to, let's just say, pre-year opening, change quite a bit, right? And didn't find a lot of career opportunities kind of in and around what I was hoping to get into. But that did lead me to a really good, corporate job in the commercial property risk insurance space, and cut my teeth in a role that was called a production underwriter. So it was one part business development and sales, and one part managing and analyzing risk on large commercial real estate projects. And I was kind of the young and probably annoying guy out of school that was always saying, our website could be better, our marketing materials could be better, our CRM system could be better, and eventually that led to an opportunity to move out to the corporate offices in Rhode Island and work on some of those projects kind of at a corporate level, and in some ways, started to run the sales and marketing department for this large organization. So it was a really great experience. I did that for the corporate job for about 3 years and learned a lot. I like to say it was kind of my mini MBA. I was, working right below the guy that was running the company, and I got to travel the world and work with our technology teams and just, work a lot of really cool projects and learn a lot. And the biggest thing that I learned, I think, was that I didn't want to be an insurance executive for the rest of my life, and wanted to start to get back to my initial passion of real estate investing. So this is 2010, 2011 timeframe. Started, plugging myself into the local real estate investment community, working for free on the weekends just to learn the ins and outs. Did some partnerships with some people, did some of my own projects, and through that experience learned that, financing these assets was one, important, and two, not super easy to get done, right? So you couldn't walk into like a Wells Fargo or a Bank of America or really even local banks and get financing for um, these homes that were primarily coming out of distress, and then the financing needed to renovate them, which led me to learn more about the private money lending, hard money lending space, and started to see some opportunities to kind of I'll call it modernize that whole institution, if you will, around creating, a technology, first platform that was data informed, that, brought certain levels of service that I thought would be important for, someone like me and other people like me that were really trying to, grow a real estate investment business. So that's one part of the journey, is, kind of getting exposure to the real estate investment space as an operator and someone that was, in need of capital. I was also doing some alternative investing in the lending clubs and Prospers, which were, very early concepts back around the same timeline of peer-to-peer lending. So, Alex, maybe you wanted to borrow $10,000 to build a deck on the back of your house or put a pool in, and credit was tight back then. So these companies came up with a way to originate a loan for you, Alex, and then syndicate that loan into like small dollar increments, like as small as $50. And someone like me could buy a piece of that credit, right, and earn interest as long as you were paying on it. And I started to think of, what if we brought these two different kind of business models together, right? On one side, people need capital to buy homes and renovate them and, bring them to kind of, modern standard. And it seemed that there were other people like me as well looking for alternative ways to deploy capital outside of traditional public equities or, other public securities. So that was really the genesis of the idea. I moved down to New York City and started building the business in 2014, 2015, and we're about 10 years later and have done about $3 billion worth of loan origination volume, and similarly funded, that amount of volume through both our online platform with these fractionalized loans and other products that we've brought to market, as well as some institutions that we've signed up on the platform as well.
Yeah, it's kind of interesting for your, kind of the intro to that, is that there's a lot of corollaries between kind of the beginning of my career and the shift in yours. I came out of getting my degree in administration and finance in 2011. And when I got plugged into this whole, space of alternative investing, a big focus at that point and what we did professionally was real estate. And I was basically sitting at my desk trying to hammer out, the big ones were Wells Fargo and B of A, trying to get investors plugged in to clear out their REO roles. So, sitting in there, just hammering these people and trying to get offers accepted and, get those things out of the pipeline back into investors' hands to rehab, flip, turn around and finance, and, kind of being really ingratiated in all of that. And then also to the point of, talking about, the fractionalized note investing with people like Prosper. I was there too when the Jobs Act was passed, and we have, all of the, Reg A stuff coming out where you have these, loan products that can be chopped up, diced up, syndicated, and, you have the crowdfunding kind of revolution coming in for people buying those. So, I was right there, kind of on the looking at all this stuff happen in real time and enjoying the ride. It was pretty interesting to watch it happen. So again, it's nice to meet a kindred spirit in that realm of stuff, because that was quite the time to be in the middle of all that. I just remember the biggest issue I had was dealing with people like, pick on Bank of America, of just how troublesome it was to try to get them to offload their REO roles was just absurdly crazy. I remember I had several contracts that we were getting kicked back because of missing commas. The person who wrote the offer, there was a missing comma, and they said, oh, it has to go back to review. And it's like, okay, what's that mean? Well, 90 days till we can look at it. I'm like, we can fix that at closing. But it was interesting. So again, kind of coming, to your point of saying, okay, we're looking at that. The first thing before we kind of get into the more granular investment side of things is that, having someone that's, really has their finger on the pulse of the market. Let's talk about, again, looking at that macro lens of kind of what's going on now and the shifts that we're seeing to kind of play into the opportunities. The big things that people are kind of looking at right now are, based in headlines. We see, they've slowed on the interest rates. They've cooled to a point, but, we're not looking at free money anymore. We're looking at a very large degree, I don't necessarily think that a 5 to 7% interest on, single family debt is anything bad, but it has kind of that trickle down effect, especially looking at the commercial markets, looking at the residential markets, especially with pricing doing what it's doing. Let's talk a little bit about kind of what's going on, what's playing into that, and then how people can adapt.
Yeah, sure. And I think for kind of where we're at today, to provide some additional context around that, we almost have to go back, all the way to 2019, right? And in maybe even before that. But we started kind of in our journey, right? Starting the company around 2015, 16. I would argue were markets that were pretty well balanced from a supply and demand perspective, right? So, what caused the great financial crisis in the '07 to '09 and '10 was we got too much supply, not enough demand, not enough real demand, right? Which created, the crash that we all experienced kind of through that time period. By 2015, 2016, I would say we had pretty good supply and demand equilibriums, right? So you had an efficient market where you had equal number of sellers, equal number of buyers. We found, kind of the right price, if you will, for single family housing. And, that was, that went on through 15, 16, 17, and 18. What everyone, as all the conferences I was going to were talking about at that time was the millennial, right? And this idea of the, I'm a millennial. I suspect you are as well, right? And we hadn't started buying houses yet back then, right? But we're one of the largest working populations, right, in the country. So everyone was trying to speculate, what is the millennial going to do? Are they going to be renters forever? Are they going to buy houses? When they start buying houses, where are they going to buy at? What's that going to mean in terms of, supply and demand fundamentals, et cetera? And then we got kind of a perfect storm going into kind of COVID, right? Which was that question started to get answered, which was like millennials are just like every other group of people that have come before them. They get married, they have kids, and they want to move to a house, right, that has the space for the kids and the dog and the school districts and everything else, right? So we started to see all this millennial demand start to come online, right, and go from being renters of Class A apartment units and trading that rent payment for a home payment. We started to see demand outpace supply. And the other thing that was kind of going on, years even before that, is no one was building new homes, right? Because everyone was a little bit still licking their wounds from the great financial crisis, right? So we had to rebuild kind of the whole ecosystem around single family home building, and we still haven't really caught up. So you had all this demand that was somewhat understood coming online at a time where we had very little supply of new inventory being created, and household formations were outpacing the actual, new inventory that was being created. So that was all kind of the backdrop going into 2020. And then 2020 was an interesting thing because of COVID and the work from home. And it accelerated, I think, a lot of people's plans to be renters for a couple more years in, dense urban populations to moving out to different suburbs and or completely different states. Which kind of took that demand up even higher, right? So it pulled forward 2 or 3 years of demand in certain cohorts and demographics of the country, and we saw the rapid home price appreciation through that period, supported by, to what you alluded to a little bit, a very low interest rate environment, right? So I think where we're at today is, some of that demand was satisfied by the people that were able to purchase in that window. That demand kind of started to slow down as interest rates went up. And the other thing that's really interesting about this space is supply is generally enters into the system as one person is selling their home and then also buying another home. So in most cases, right, the net supply is zero when someone sells a home, right? Like 70% of home sellers are home buyers, right? So all those people that have low interest rates that may have otherwise listed their home for sale as they're looking to buy, the next larger home or move, or holding on to that inventory. So we're kind of back into a situation where the demand hasn't completely gone away. It's probably being delayed a little bit while interest rates kind of resolve themselves and settle in. But we have still a fundamental kind of challenge on the supply side, both as a function of we haven't built enough homes, as well as a lot of the inventory that would normally be transacting is kind of stuck in a low interest rate trade, right? That they're not ready to get out of yet, right?
Yeah, I mean, I think there's kind of two aspects to that. At least from my personal viewpoint on this whole thing, is that you have kind of a populace that is to a point trapped, in that low interest rate environment. I'll raise my hand and say I'm kind of one of them. Not to kind of rub it in any form or fashion, but I managed to refinance our mortgage like, I mean, almost the very bottom. It was like 2.65 is like my total APY, like on my refi. And, it's like to the point where you have people that are in, that boat, or even that, let's say got it at 3, or, let's call it 4 or less, that don't really have an appreciable option for trading up or kind of doing the more traditional, looking back over 30, 40 years of saying, okay, you get your starter home. Okay, great. You build up some equity, then you can move up because your equity's built up. It's a lot of lateral moves now. And with the increasing interest rates, I haven't really seen, at least personally, the correlation between the interest rate rise and the pricing drop. That was kind of the idea behind raising those rates, is to kind of cool off the market. Well, to cool it off, you have to make it slightly more affordable. If money gets more expensive, then the underlying asset needs to drop in value to a point. But I haven't really necessarily seen that. And maybe it's market specific. Where I live in Florida, again, is a little bit, I think, anomalous to the broader context of the U.S. But I think any large population center is probably seeing relatively similar influences to its market. And then additionally, too, you also don't have increasing wages to make up for the again, the high asset value and high pricing of these things. So what does that kind of drive in the marketplace? Does that play into some of this stagnation, or are there kind of avenues around it? Or is that just, am I just seeing this completely incorrectly?
Yeah, look, I think that's right. I don't think we're seeing, negative home price, kind of resets. And I think there was a lot of people that were postulating that may happen. I never believed that would happen, which again, just kind of goes back to this idea of, the housing market operates like any other market. It's a function of supply and demand. And as long as demand is greater than supply, right, there's not an incentive, right, for you to sell your home for less than it's worth to you. Right. So I think short of a large supply shock, to the system, like how do we actually see home prices come down? And what would be an event that would cause, a large supply shock? I can't imagine what one would be. And the reason being is, as much as, this market operates like any other market with, supply and demand fundamentals defined, right, the equilibrium of price. A house isn't just a commodity. It's not a product, right? It's a place that you live, that you raise your family, that you, right, that you have a fixed payment against, right? Right. So people don't trade in and out of their homes relative to what they think the value is. There's some other kind of implied value to that, to that cost of shelter, effectively. So yeah, I mean, look, we saw some home prices come down in some markets where they probably got too hot, right? And the supply did kind of outrun the demand, or at least the long-term demand, but not something that we're expecting now, short-term or even long-term. I think what we will see, and I think, to your point around what the rising interest rate did do, is it cooled off what was otherwise unsustainable home price appreciation, right? So we were seeing 15, 16, 20% year over year jumps in home values, which really is unhealthy. And, you heard the stories of people going to look at open houses and 40 offers getting submitted and 39 of them were over asking price. And like, that's not really a healthy market, right? So we're seeing less of that. We're seeing days on market return to, a normal and healthy level, which, from our perspective is good. And frankly, it's more sustainable for, what we do. And in kind of the space that we play in. So while it didn't bring home prices down, what it probably did is accelerated home price appreciation over a 2-year period that would have otherwise taken 4 or 5 years. And I think what that means for the next couple of years is you're going to have flat, right, HPA, or modest HPA, home price appreciation, until a point where it returns to the mean, right? It reverts to the mean of what it would have been had we not seen that 2 or 3 year compression on all that HPA, right?
Yeah, and I think as kind of a look at different markets, I almost feel like the markets for homes have almost been fractured. We always look at it as kind of a large average. You take the entire United States and you kind of look at it. And yes, there are individual markets, but I really feel like there's almost been a fracture between your large population centers, your Tampa's, your Miami's, LA, Austin, New York. Oh, maybe people are leaving New York, but the larger population centers that have drawn a lot of these sales that you're not going to have. I mean, there really is no functional way with the amount of demand in some of these markets to have anything that's going to occur that's going to have that, that graph skew any direction other than what it's been doing with, continued appreciation with a lack of supply, because there's only so much. Most of the urban sprawl with a lot of these places kind of took place in the 60s, 70s, and 80s. Especially in your coastal cities, there's only so far away you get from that population center, before you start running into issues with desirability of location. So again, I think it's almost interesting to take a look at it, is that you're almost kind of dividing the marketplace into two different sectors of emerging markets, ones that haven't seen that are starting to become more attractive, either through things such as people wanting to leave where they're at, new governmental regulations and tax incentives, and becoming more friendly to businesses. But it's just kind of interesting to think now, from your perspective, do you think that holds water? Do you think there really is kind of a fracturing of the markets in general, of kind of new emerging to existing large population centers as it relates to what's going on in the real estate markets?
Yeah, and yeah, look, I mean, I think in some ways real estate investing isn't, rocket science on a kind of a high level. It's like, where are the people going and where are the jobs being created, and like housing, either needs to lead or follow that, that demographic trend. So, yeah, I mean, I think we approach kind of call it the more established cities a little bit different than the emerging kind of markets, from the types of projects and the type of operators that, we're looking to provide financing to. We like some of the, the more established cities because of what you said, right? There's no more land, right? There's nowhere else to build, right? So there's a lot of opportunity to take, the home that was built, at the turn of the century, and bring it up to modern standards, whether that's from windows and roofing and, HVAC and all that stuff, but also, how the floor plate of the home is laid out for, living today versus how it was, 100 years ago. The other side of that is like, there's towns and neighborhoods, outside of Charlotte, that aren't built yet, right? But like will be built, and they're still within, a manageable commute to, Charlotte. And the projects that we're looking to finance down there look very different, right, than something in Boston, for example, right? So I think it's just different, but on their own, they each have, interesting and attractive attributes from a real estate investment perspective, but they need to be approached slightly different from how you underwrite and how you think about risk and price it, and ultimately the product that you're developing, right?
Yeah, and I think that's kind of a good segue into kind of the next part we want to talk about, is more of the investment side of it, looking at the different markets and what's kind of led us into the current situation where we're at, where again, we have a still low supply, relatively, again, we're not seeing demand at 2021, 2022 levels, but we are still seeing a a very high demand. There's been some cooling because of the expense of money and the velocity reduction in that, but again, we still have incredibly high demand in most major areas, especially for places that you want to underwrite. You don't want to, maybe Topeka, Kansas is not the underwriting capital of the investment world, but certainly places like Charlotte, with everything that's going on there. The Tampa Bay area is still crazy. People are always going to live in Boston, so there's still certainly need for that. So maybe let's kind of again transition more into kind of the realm of your investment thesis and what you like to do and how you're going about it in this current market. So again, you mentioned Charlotte and Boston, so let's start in Charlotte. I'm a down here in the southeast, and enjoy knowing about my markets in my backyard. So let's start there.
Yeah, and look, happy to talk about specific markets, and I don't think there's also anything wrong with Topeka, Kansas, right? There's people that live there that need housing, that have either a shortage probably of the new product that's required for some of the move up builds, as well as housing stock that needs to be renovated. So we also do a lot of work in the Midwest. Columbus is a big market for us. Cleveland, Pittsburgh, Detroit, we've done stuff in over the years, right? So I think the way that you opened this whole podcast of like there's a lot of different ways to make money in real estate, I think is true, and there's a lot of different markets where money can be made as well. I think Akron, Ohio was rated the top investment real estate market by one of the guys that rank these different markets, just as a function of as much as you're not going to see the rapid HPA that you might see in like a Charlotte or a Tampa or a Florida, you also don't see the beta on the downside, right? So long way of saying is I think there's opportunities in a lot of different markets beyond just the markets that make all the headlines for all the growth and all the jobs and all the factories and things opening up. You just got to find the right type of operator that has a perspective on what the strategy is and what the right business plan is for for that given market, right? So we operate in, I don't know, 33 or 35 different states, and they're all a little bit different, and I think we like all of them, otherwise we wouldn't be there, right? But I think from our perspective, it's more about how do you find the right person in that market that has the right business plan, the right acquisition strategy, the right renovation team, the right liquidity, right, to ultimately execute the plan that we're going to finance. And those can come in a lot of different shapes and colors. But the most important, one of the most important things for us is like that quality of that operator, right? Do they know how to acquire the property right? Do they know how to manage, the renovation of the project? And then ultimately, do they know how to disposition it, right, for the maximum value, whether that's through, for sale or, renting it out and getting longer term financing and building out, their rental portfolio. So, yeah, I think for us, the way we've structured our business is making sure that we have, some level of understanding in each market, right? Because they're different, right? Boston, we do multi-million-dollar renovations in Martha's Vineyard is going to look a lot different than Mobile, Alabama, and workforce housing and affordable housing that's being built down there. So, like I said, I think a lot of different ways to do it, but the consistent thing across all those markets is, do we have a good operator with a good business plan, with the right the right entry point on that asset, with a perspective on how value can be created for everybody to make money on the back end.
Yeah, and before I get into the really kind of the salient point that I'm going to bring up, you mentioned Detroit. That is one of the markets where I haven't quite understood why it hasn't exploded. I mean, you have, everyone complains about how expensive real estate is. I have a lot of family up in, Detroit adjacent Michigan, and there's still plenty of jobs up there. The real estate can be extremely cheap. There's a huge push for revitalization of a lot of the surrounding areas that were blighted. And again, people, it's like, oh, everything's so expensive. I'm like, well, maybe where you are, but I mean, just look outside of your back door. I mean, I don't know why Michigan gets so much flack. It's I always enjoy it when I go up there. And from all outward appearances, there's been significant appreciation in a lot of the different suburbs. There's good drivability. It's, quality of life, as long as you're not living in an extremely blighted area, seems to be pretty good. So that's one of the ones where I never quite understood, but I can definitely see the attractiveness of, kind of going from, like you mentioned, like Pittsburgh down into Ohio, Akron and stuff. It's that same kind of analog of the, depressed real estate values now kind of coming back online. Again, I'm just not sure why it hasn't necessarily gotten to Detroit as much as I would think, but maybe it has. Maybe I'm missing it. But
there's pockets, I think. There's pockets where it's gentrified and it's pretty hip. Haven't been up there in a while, but yeah. Like I said, each market I think has their area, right, where the types of people that we provide financing to have developed a perspective on why it's a good market, and sometimes are leading the charge into changing a market, and others typically follow, to the extent that they have success. So it's everywhere. It's surprising to me. But yeah, it's fun.
So now getting into a little bit about strategy and, your investment philosophy, you mentioned, again, kind of looking at operators, what they're doing, experience. And I think those are great high level things that everyone should really kind of take heed of, because, while it may sound simple, it's like, yeah, you want to, make sure you're investing with people that know what they're doing. Well, if you hear things get repeated on this podcast or anywhere in life, maybe there's some truth to it. It's make sure the person that you're investing with, if it's not yourself, knows what they're doing. Make sure, would you like your doctor to be putting the first crown ever on your tooth? Would you like your, surgeon to be doing its first open heart surgery on you? It's, let's make sure you have some people that have done stuff once or twice. But, to that point, again, kind of getting into what you're looking at, are you primarily looking at underwriting and operators who are dealing in single family, commercial, light commercial? What is kind of, again, the things that you focus on as far as the, the investment criteria for this?
Yeah, so our platform, we specialize in single family the single family asset. So that really goes into, one family up to four family. So we'll do duplexes, triplexes, quads. We dabble a little bit in, mixed use and, maybe a couple 5+ units, but most of our product is, 1 to 4 family. And that kind of splits really into two worlds. The first is called, traditional fix and flip. So there's already a home there. It needs, usually some amount of significant investment to, renovate it and make it marketable. And then the other big part of our business is ground up new construction. So it's a plot of land where, a developer has a perspective on building a new home. And, we finance the acquisition of that dirt and then the construction of the actual property. So yeah, we are pretty much exclusively focused on the single family space.
Okay, so that's kind of good two trajectories. Either the renovation, reposition, rehab, and then the ground up new construction. So let's kind of focus on those two buckets for a second. Now, with regard to kind of what it looks like from an underwriting standpoint, from from the investment side of things for the rehab, reposition crowd, what are some things that you kind of look for, and what kind of pricing, what kind of like turnaround are these things seeing? Is it increasing, decreasing? Loan terms. Again, I think you kind of know what I'm getting at with that, and then we'll certainly cover the ground up stuff and the inherent risk and benefits to that. But what are some things that you're kind of looking at in this particular market structure that we're in on that bucket?
Yeah. So a couple of metrics that I think are important to understand if you're going to get into doing, let's call it, some type of private lending against a single family asset. The first and foremost, as we kind of alluded to, is we like experienced, borrowers or, operators. So we look for what's called like kind experience. So if you've done 2 or 3, what we call cosmetic fix and flip. So, right, paint, some flooring, maybe a kitchen replacement, some bathroom replacements. We like to see that you've done 2 or 3 of those before. There's also larger renovation, we call gut renovation, right? Where it's like you're taking walls down, you're doing mechanicals, there's new roofs, there's new windows, right? It's just a more intense project. If we're going to finance, someone on that, we also like to see, right, a track record of that type of project. Requires more permitting, more, just overall management of the project. So the first thing we like to start with is just that experience and that track record, and then we're doing a lot of other things: background checks, credit checks, liquidity checks, to ensure that we're dealing with someone that has the not just the experience, but the financial wherewithal, and is the type of person from a character perspective, right, that we want to lend money to that we think is going to pay us back. So we start a lot of our analysis with getting to know the customer and kind of their story and their track record. From there, then it moves on to the project, right? So, assuming we get comfortable with the person that is behind the project, or the people that are behind the project, the next thing we look at is the actual home that we're gonna secure with our debt, right? So, first thing we look at is what's the property worth in its current condition, right? So if he's buying it for $100,000 or she's buying it for $100,000, do we think the property is worth $100,000 in its current condition? And if so, we're going to lend a certain percentage against that initial value. We call that the loan to as is value. And we're typically somewhere between 80 and 90% of that loan to as is value on that first distribution. The second number that we look at is what's the home going to be worth once it's fixed up, right? So it's worth $100,000 today. We think once it's renovated and it's up to its highest and best use, we think it's going to be worth $250,000. So the second thing we're going to say is, okay, once we're fully, dispersed against all the renovation that we're also going to finance, we don't want to be, typically more than 65 or 70% of loan to value, right? So whatever 65 or 70% of that 250 number is kind of our max loan amount. And the third thing we spend a lot of time on is then what's the plan, right? Like, how are you going to take this from a $100,000 home to $200,000 or $250,000 home? How much is that going to cost? Have we accounted for everything that's going to need to be done to kind of realize that value? And then we're going to fund a certain percentage of that renovation budget, up to 100%, depending on can we stay within kind of the right loan to value ratios. The other factor we like to look at is in loan to cost, right? So that's the total cost of the project, both from an acquisition as well as renovation perspective. How much of that do we want to finance? And typically we're going to be, again, 80 to 90%. And the difference there then effectively comes out to like the borrower's equity, right? So how much skin does the borrower have in the game? that they're going to only be able to recover once they pay our loan back, and hopefully also return a profit for for their efforts. So it's borrower and then it's project, and there's really kind of 3 or 4 numbers that you're looking at: loan to value, loan to cost, and that first distribution value ratio.
Gotcha. And with regard to kind of the scope of these, are you strictly only looking at again someone that's looking to exit and flip these, or is it something that you also maybe have a product, or you're okay with something that is going to be held as more of like a portfolio for rental income? Is the debt basically structured to be like, hey, like let's get in interest only 3-year balloon, or is it something longer? Or do you kind of just look at it individually, or look at renegotiating terms after a certain point?
Yeah, so good question. So that loan I just outlined, I didn't answer part of that question. It's typically a 6 to 12 month loan, right, depending on the scope of the project. And an investor that would invest in one of those loans can expect anywhere, call it between 10% and 11.5% return on their money, which gets paid out monthly as long as the underlying borrower is making their payment. So they're interest only payments through the term of the loan. They tend to be inside of 12 months. A good number of our borrowers will, during that 12-month period, instead of selling the home, they'll tenant it, right? And then they'll use that they call a seasoning period to then get longer term 30-year, 15-year, 10-year, right? Mortgage, and we offer that product to our customers as well. So they are different loans, but we generally like to understand, what is the exit strategy? Are you going to be selling this home? Are you going to be renting and refining? And there's a somewhat of a different analysis in terms of we got to get comfortable that if it is a rent and refi, right, there's going to be enough that next underwriter, if it's us or someone else, is going to be able to take our position out through that refinance activity, right?
Yeah, and that's one thing that I kind of don't see as often, and I do like to see, especially from the security standpoint from the investor side. And we'll get into that. We haven't necessarily covered kind of your packaging of these as far as the investment goes, but I've seen and there's nothing necessarily wrong with that if you have a very good scope of what you do and do well. Not necessarily always good to branch out of it. Again, for what it's worth, but to be able to have someone where you can acquire the financing from a single institution, and then if the strategy changes, say, hey, look, market's changing, rents are going through the roof, this would be a much better rental than me turning around and flipping it. Yeah, we can then in turn renegotiate with these same people and have a different loan product in place, as opposed to saying, hey, you know what, we only do the fix and flip and the construction, rehab, X, Y, and Z. You're going to need to find outside debt for it, because then they have to go, okay, well, now we need another relationship. If they don't have someone else, they got to go out and find it. And that can, again, kind of squeeze, what they're doing and doing well on that project to be able to say, hey, you know what, I got to figure something else out with someone else. So again, it's kind of, from the investor standpoint, I kind of think that's an interesting avenue that I haven't seen a whole lot of other people take. Certainly not the only people that do that, but I would say more often than not, when I see lenders, they kind of just focus on one aspect of it for whatever reason. Certainly they have made it work, but I never quite understood that one to a whole perspective. Now, when it comes to the new construction stuff, again, that's probably going to be more often than not going to be a position for sale. I would imagine, unless you're seeing people change, or is the market shifted, or is it basically, if it's the new construction, again, speculation doesn't have to be a bad word, but they are going to be a little bit more speculative if you are building something from the ground up. For that, what does that look like in difference to the the purchase, rehab, refi, or market?
Yeah, so it's definitely a different risk kind of profile. Some with I'd say higher risk profile, some with perhaps lower risk profile. So the first element is on a fix and flip, you're financing a property that's already right erected and right presumably livable, or it could become livable with a certain dollar investment. New construction, a lot of time it's dirt, right? So there's nothing there. So one of the ways that we manage that risk is our loan to value is lower, right, on new construction than on fix and flip. So I mentioned kind of that 80 to 90, I think, range on the fix and flip. we're typically going to be, 40 to 50, maybe 60% on the value of that land before we start to get any, improvements made to the land. So there's some additional risk on the early part of a new construction project as it relates to dirt is less valuable than right a constructed home. So we protect that by just having a lower advance rate or a lower attachment point. Um, I would argue that once the foundation gets laid and once the framing goes up and the roof gets put on and the windows put on and the home's sealed up, you've got a better risk profile than you perhaps do on a fix and flip, because you're not going to have any of the surprises that are going to come with a fix and flip that inevitably come with certainly larger scale fix and flip projects, right? So once you get that new construction project, all the way vertical and sealed in, those projects can move a lot faster than even some fix and flips can, because it's just it's a clean slate, right? We also tend to see, and this is not by any means a knock on our fix and flip clientele, but builders have to operate at a larger scale, right? So they tend to have more labor on payroll and more relationships with suppliers where they're buying things in bulk, right? So their labor and their materials that go into those homes can be purchased at perhaps better pricing, which brings down the risk of the overall project. Those are some other things that kind of go into the risk profile of a new construction build. One good example of this is particularly over the last year and a half, is a lot of our builders that maybe had plans to build let's say a 2,600 square foot home decided to instead build 2,200 square foot homes, right? Like, because they said, hey, like if I take 400 square foot out of the house, it brings my cost down, which means I can sell the home for a lower price point, which allows my buyer that can only afford a lower price point to still get in, and I can still deliver a 4-bed, 3-bath, right, product that the market will want. You can't really do that with a fix and flip, right? You kind of got what you got. So I think the builders also have a little bit more ability to be nimble, and adjust even things like finishes and stuff like that, to meet a market based on interest rates and a lot of other things that go into that. So we like new construction. I think it also kind of goes into this earlier part of our conversation around, we just fundamentally have a shortage of housing supply, and the only way that that's going to get resolved is by creating new supply, and new construction is really the only way to fundamentally do that, right?
Yeah, no, it's definitely a great point. I never really kind of thought about it through the lens of the benefits of new construction. For good, bad, or indifferent, I typically see new construction as something, at least for my own investment philosophy, as something that, it's just not something that interests me. And that's fine. It's what people need to understand a lot about investing that I feel like is kind of missed is just because it's not for you doesn't mean it's not for someone. Just because something has a different risk profile, it doesn't necessarily make it more risky. And in this case, you're trading the risk of all of the what ifs that can happen in a rehab. You don't know. Things get missed in inspections. Markets shift, and all of a sudden you need to do something different. As opposed to if you're building something from the ground up, okay, great. It shifts a little bit. Okay, well, it's a little bit easier to take a couple hundred square feet off that, and instead of having it all closed in, okay, stick a carport there. Make it a little bit cheaper, make it adjusted to what's going on, as opposed to really being locked in to those four walls and a roof in that rehab project. And anyone that's ever been invested in real estate knows that yes, materials can change, your labor costs can go up, but you can find some absolutely wild stuff in a rehab. I just did a podcast with a gentleman that is doing a kind of really interesting play with assisted living facilities in Texas, where it's all over the place, really, but it's not the big kind of commercialized ones. It's basically kind of like 16 bedrooms, all in one place, medical, memory care, all kind of that class A facilities. But his first rehab that he did, he found out just how expensive redoing a fire suppression system for a commercial building can be. And one thing I brought up to him that he was like, I was kind of surprised that I knew it. It's like the wiring that you have to use for a commercial grade fire suppression system has to be insulated with minerals that cost, like, it's not just copper wire. It's like, it goes from like maybe being like, $1 a foot to like $16 per foot on these little wires that you have to use. And you'll run into things like that. Granted, that's a very specific use. It costs them like 150 grand of just unexpected stuff for fire suppression. But you run into stuff like that. And it's a little bit easier to literally see what's going on when you can see through the building in new construction.
Yep.
So
Yep.
let's get into a little bit about the to kind of round this up about kind of how you package these as investments. We've looked at the marketplace, we've looked at the different benefits to someone that wants to underwrite a particular project, where the risk profiles lie, what you're kind of looking at as far as what your LTVs and your exit strategies are, and the repositions that can happen. But everyone kind of always wants to know. It's like, great, we know what's going on. We understand the benefit of this investment. How do I do it? And kind of how do you package these together? We've talked about, what you're looking at as a company, but, as far as an investor standpoint, what can that look like if someone's, going through you to invest their capital?
Yeah, and we didn't get into too many specifics about our actual business, but we really have two businesses inside of one business. And we spent a fair amount of time talking about we'll call our origination business, right? So we have an entire business that's, out in the market looking for good operators, doing underwriting, and originating those loans. And then we have a investment marketplace business, right, where we make a certain percentage of those loans available to individual investors like myself, like yourself, like really anybody that's out there that right now is limited to accredited investors. So definition by the SEC, certain, either net worth thresholds or net income thresholds. We have a couple different ways for people to participate on the platform. The first one is kind of the one that we went to market with, which is the fractionalized note, kind of the peer-to-peer, method. So you can sign onto our website and look at, I think we've got 30 or 40 different loans open at any given time. And you can literally pick the project that you want to support. So whether that's in Akron, Ohio, Cleveland, Ohio, Charlotte, North Carolina, down in Florida, new construction, fix and flip. We provide a fair amount of details around, all those LTVs and LTCs and FICO scores and all the stuff that we kind of uncovered during our due diligence and why we, funded the project. And those loans are already originated. So they've already been priced. They've already been underwritten. They've already been properly perfected from a first lien position. And you can start to invest in those as little as $5,000 per investment. So one of the big kind of things that I wanted to do when I started the company was, make this asset class more accessible to more people. So having a relatively low minimum investment allows people to really build their own portfolio if that's kind of the way that you want to go about it. We also then have, on the other end of that spectrum, we have funds, right? So if you're less interested in kind of picking one by one properties and building your own portfolio, you can invest in as little as $15,000 into one of our funds. Right now we have a private REIT structure set up, so it also comes with some additional tax benefits. And effectively what that is, it's same asset class that kind of we've talked about throughout and that, our platform is designed for. It's just a fund kind of make some of those decisions around which loans to buy from our origination business. And it also benefits a little bit by having some back leverage. So we create quite a bit of efficiency on that capital being deployed to making sure it's always working and generating a yield ultimately for our investors. And then we have kind of a hybrid product in between those two, which is it's still a debt product, it's a short-term note. And it's capital that is used for us to originate and fund the loans before they either get syndicated out on the platform or put into the fund, or we sell some of our loans off to institutions as well, like large insurance companies, hedge funds, et cetera. So this third product I'm talking about is short-term fixed income product that's still backed by those underlying assets, but the assets are really not held to maturity, but really it's almost like our warehouse line, if you will, for for the inventory we're creating before we're placing it.
Yeah, kind of that like retail of just kind of like bring in, season out, kind of a little bit more of a marketing for capital type.
Yep.
Yeah.
Yep.
Awesome. Well, it's I really enjoy talking to people like you, especially that have had such similar kind of experiences in these markets. Granted, mine's coming from a little bit of a different perspective, but I find these conversations incredibly engaging, and my producer would definitely kill me if we ran this thing for 2 hours. So trying to make everyone happy and package the content correctly. So if people are interested in learning more about kind of the exact investment opportunities and everything that Upright has going on, what's the best way to reach out?
Yeah, upright.us is the website. We've got a fair amount of information on there on how to get started. Pretty easy to create an account. We've got some, I think, 10-step, 12-step guides on how to get started, and we try to share a fair amount of information on how we view the space and how to think about it. And then yeah, if you create an account, someone from our team will likely reach out to you within 24, 48 hours. We've got a fully resourced investor relations team that tries to get a hold of all of our investors and prospective investors, and super knowledgeable on the business and happy to answer questions as well. So creating an account on the platform is enough to get our attention, and someone will be in touch for sure.
Fantastic. Well, again, thank you so much for your time today, Matt. Really appreciate it. For everyone, thank you very much for joining with us. This has been another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and have a great day. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.